Hit it.
It's Friday, December 12th, 2025, episode 280. I'm Patrick Ceresna.
And I'm Kevin Muir. This is the last Talking Charts for the year. I know I'm sad.
I'm sad too.
We're all sad, but hopefully Patrick will make us happy with some reading of the tea leaves.
Absolutely.
And while we're talking about Patrick, you got a new trading challenge this week. What's up?
Okay, well, listen, we're hosting an asymmetric trading challenge next week. So let me just explain what asymmetric trading is. So asymmetric trading is the art of losing small and winning big by design. And for the first time, we're running an asymmetric trading challenge where we show you exactly how to find and build these trades in the real market. So come and join our special webinar on Tuesday, December 16th. At 4 p.m. Eastern time. The link is in the description of the YouTube below, or you can just visit bigpicturetrading.com to register.
All right. Do you have a beer? I thought you did well, Patrick.
All right. Well, listen, I do have a beer. Now you're not drinking it because I guess one of your kids must have drank it or something. Because like this is
it's true.
But what's it called? Danny and I have actually the beers, and I thought this was actually appropriate for you, Kev.
I know.
It's called the Party Dad.
I'm thinking I might have.
You are the party dad.
I am not really. I am not the party dad. You are the party dad. Okay. Maybe you gave mine to Danny.
So Danny, what are we drinking here, buddy?
Oh, wow. Okay. So we're drinking Party Dad, which is a IPA, very low alcohol, which is why I thought, yes, it was very significant to Kevin because he likes his low alcohol beers.
Yeah, 3.5% for an IPA, Kev.
Geez, I would have loved it.
Yeah, exactly.
It's for a party dad.
It really was. It was my beer. I'm going to go find it. Okay.
There you go. And Kev, give us the disclaimer, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the hawkishness letdown syndrome, HLS, Fed relief reflex disorder, the FRRD, and then the pre-payroll performance anxiety, the PPPA. I haven't got that, but I hear most guys do have it sometime in their career.
At some point. All right, let's get to the guests.
It's our great pleasure to welcome to the show a good buddy of mine, someone I always enjoy listening to, and somebody who is a fan favorite. It's none other than Vincent Deluard, Director of Global Macro for StoneX. Vincent, thanks for coming on the show.
I'm so happy to be back here.
Yeah, we get you right before Christmas. Are you going to be in the U.S. or do you ever go back to France for Christmas?
Yeah, it really, I mean, because, Europe is almost in the North Pole. So December because I come from like the northeast of France. So it's really depressing. So I try to come home, in the summer or the spring when
you have turned into a soft Californian, my friend. You are a soft Californian. France is in the North Pole. Okay, let's talk markets because you recently had a little bit of an epiphany and you've changed your thinking about something that's been very big to you. Why don't you tell us what this new thought is that you have?
Yeah, so I feel, if we go back to our conversations we've had, both you and I really have been generally very bullish on economic growth and kind of, pointing to this great reset, right? Higher growth, higher rates. And in a way, I think it was a rebuttal of some of the boomer doomer theories that, deflation, debt, and the 5Ds, all that stuff that was really popular in 2010s. And they were pointing, no, that like nature is healing to some extent. Growth is better. And my view was that eventually we would kind of stumble into a policy mix that would get us out of this debt crisis, that, we could do the thing that we usually do in that crisis, which is you increase G and you repress R. right?
Okay.
If in dividend discount model, so increase G, mean you adopt pro growth policies, which I think we are seeing to some extent, and we
Right.
are seeing much faster growth since COVID, and then you do financial repression, where you cap interest rates, you do QE, you force banks to hold treasuries, so forth, and historically that's how we've gotten out of that crisis. And my view was like, this is kind of normal. This is, this happened every 75 years or so. It's kind of the fourth turning argument, and we're going to get out the same way that normally get out. Yeah, I'm starting to think that this is not normal. This is not a debt crisis. This is a different problem. And I'm starting to worry that the policies that we are adopting are actually making the crisis worse instead of making it better.
Now, explain to me what prompted this, and in what way do you think it's different, and what do you think the policies that we're doing are like? How are they making it worse?
Yeah. So what prompted is really this conversation that we seem to be having, daily now on inequalities and affordability. I mean, you saw that with the New York election. Now we have it in Miami as well. I was just reading that piece that my good friend Mike Green posted, and got this whole Twitter steer. It's kind of funny, right? You have a Marin County hedge fund manager kind of almost talking like Bernie. I mean,
a libertarian too, a Peter Thiel, a libertarian. That's the part that I think is the funniest.
Yeah. But I mean, for what it's worth, I mean, it's funny how we got like attacked by this kind of like, Heritage Foundation, Koch funded guy. I mean, he was always a friend, but seeing him being attacked by these people, I think made him even more sympathetic to me more. Yeah. So it's this conversation about, affordability. And it makes me think that, the problem is not debt. We don't have and I'll die on that hill. Like I think so much of that conversation, and perhaps even intentionally misleading, about you have this coterie of economists that are always, the CBO, the CBO this, and look at the debt, and they have like free reign on financial TV, right? If you're an economist and you complain about debt, you'll immediately gain, what a serious man, he thinks about the long term, and of course I believe there is an ideological angle to this. I mean, very often these economists come from places that are funded by people who have an interest in kind of making the conversation about debt rather than inequalities. But really the problem is not that. I mean, if we look at private debts, we solved it. I mean, we had 15 years of forced deleveraging after 2008. We can argue it was brutal. I mean, Dodd-Frank essentially did that by rationing credit to the wealthy, basically. So we don't have a debt problem because the poor have not been able to take loans, at least on a significant basis. And I would argue on the public side, we don't have a debt problem either. Even the deficit, I would argue, we had 5.8%. I mean, the economy is growing real at almost 4%. You add 3% of inflation. You see tax receipts going at 8%. And it's the US. Like that's the part that annoys me about this debt conversation. Remember the Reinhard Rogoff paper?
Oh yeah.
It's
a whole book. Forget about a paper.
Yeah, the Excel depression, right? These guys couldn't even check. Supposedly this magical point where, if you debt to GDP crosses a certain level. I mean, how that got published really bothers me. And how is that relevant? Like, how is the experience of New Zealand in the 1980s? I mean, we're the US. Like, who's going to come and collect the debt? The only time I could think of was when the French invaded Mexico in the late 19th century to get repaid. Like, I mean, no one's going to do that. Okay. Yeah. Like we don't have, we have so much assets. We have so much wealth. We have so much ways we could tax more. Yeah. That really, this debt conversation is to me kind of almost a red herring, like something that's here to mislead people. But what we do have, is an affordability problem. And I was, kind of dividing the, everybody now is coming up with their own measure of how life has become unaffordable. And you see all the memes on Twitter about in the 1950s, a working man could afford this kind of house. I mean, I was taking median wage, and then I divided by a bunch of stuff. I divided by stock prices. I divided by cost of healthcare. I divided by home prices. I divided by the price of a Vail ticket, by the price of a Disneyland ticket. And yeah, what you see is pretty steady erosion of 3-4% a year in terms of how much college you can buy with a medium wage, how much unit of housing you can buy with medium wage, how much health. That is the problem, not a debt problem. It's an affordability problem. And my impression is that this affordability problem is in large part driven by the fact that asset prices are really, really high. And that there is a cost to this. And then maybe it's because I live in California where, I see this massive gravy train, and it makes life harder for the people who are not part of it. Like if you suddenly your neighborhood becomes
million
overcrowded with
the stock.
NVIDIA, I think 80% of NVIDIA employees have more than 20 million. Or you take
is it really that high?
Yeah, it's shocking. I mean, all you have to do is just be there. I mean, that's, and maybe that's my envy talking, but I remember when I first moved here 20 years ago, when my roommates were in tech, and I mean, they're smart and wonderful, but like if you just stayed at Google for 20 years, I mean, you didn't create a company. You didn't. I mean, of course, it's hard. I don't want to underestimate, but you have generational wealth without having done the things that I would usually associate with. You haven't become a successful hedge fund manager or started a multi-bit. No, you just kept your job. And when you have like so much wealth on such a small perimeter, it means that private school or it becomes completely unaffordable. Housing is completely unaffordable. So the middle class is pushed out, or then you start having homelessness issues. I mean, it's basically the K. You see it in San Francisco, right? You have the obscene wealth, and at the same time the people shooting up in the street. So this affordability problem is ultimately driven by the fact that asset prices are too high. That's the point that I'm always trying to make. And if we think of wrongly, if we misspecify the problem, if we say it is a debt problem and not an asset price problem, we have the wrong policies. Because what do we do if we think it's a debt problem, right? We go back to this R minus G argument. Okay, keep R low, repress it, and then boost G. Now, feed that into any dividend discount model. Basically, what we're trying to do is G is greater than R. Well, what happens to prices is prices go to infinity. And I think that's exactly what we're seeing, that this is Trump, basically. We have very strong pro-growth policies, as you and I both have argued. We had them under Biden too. Since COVID, we've had very good growth. And at the same time, we have financial repression. R is kept way below. This is why, our steepener trade never works, and the bond market vigilantes never show up. And we're constantly wrong on that one. And the effect is that you boost these asset prices even higher and higher, and you make the problem worse and worse. And that feeds into this kind of political cycle that we are seeing today.
So I completely get where you're coming from. And I thought it was interesting when we had this issue with the Liberation Day. And if you recall, Trump would say, the world's ripping off the US. That was very common. Like he kept saying, the world's ripping us off. The world's ripping us off. And I kept thinking to myself, correct me if I'm wrong, if I'm mistaken, but you guys are the most powerful, richest country in history, and somehow you're getting ripped off. Somehow you're coming out on the short end of the world global economic system stick. And I kept saying the US doesn't have a wealth problem or an economic problem. They have a distribution problem. The problem is that all the wealth is held by, an elite few. And I guess you're coming at it very similarly. You're saying all the wealth is sitting in these companies And yet we just keep sending these companies higher and higher with our policies that we're trying to fix and make things better. And yet all it's doing is helping, the companies to go higher. I guess what I would say to you in terms of my immediate pushback is Trump said he wanted to help middle class and lower regular type folks. But when at the end of the day, the moment the stock market got into trouble, he tacoed. So isn't that really truly the problem, is that they can't take the pain that is required to rebalance the economy?
Yeah, I 100% on everything that you said. Yeah, and I think it's one of the contradiction of Trump. I mean, Trump in some part, he's kind of if you hear him talk, I think he understands some of that populist energy. Like I'm going to be your retribution. I'm going to be the mentor of the forgotten man. I mean, and in some ways you hear him talk and he just sounds like, one of these, CNBC like, Kudlow type, stuck in the 80s and, just like cut some damn taxes.
Yeah.
And then the stock market up is good. So that's his contradiction. Now, I think the way he managed to reconcile it and get elected was by saying we're going to take it from the foreigners, because at the core, I think everybody, at least who's honest, sees that the money's got to come from somewhere, right? I mean, if we're going to improve the lot of the forgotten man and the bottom of the K, I mean, you see the two legs of the K are moving in this. So you're like, okay, to fix it, we got to take from one to give to the other, right? Now, of course, in the U.S. political system, it's kind of hard to do because you need the top of the K to pay for your campaign and you need the bottom of the K to vote for you. So that's, for example, the Democrats, the Hillary, the Kamala, they were really good with the top of the K. They just couldn't get the bottom part. Trump's genius is that he could get both. Now, why? Right. It's exactly what you said. It's we're gonna take it from foreigners. He points to like a third group. It's like, don't worry, you can have your cake and eat it. I can have my billions donation, and I will take care of the common people. And I mean, there are policies of his that do address. I mean, I think that's why there was this kind of working class shift from Democrat to Republican, because they could see at least the hint of a plan, right? Restricting immigration, no tax on tips, no tax on overtime. That's more than anything that Hillary ever proposed,
right?
And he had this magical money tree. The foreigners are going to pay for it, which, we talked about it many times, like that was always a lie, but it was a good lie. Like we hadn't tried tariff in 75 years. So no one remembered that it doesn't work. So that was it. And then the second thought, I'm just jumping here on what you said is, I'm reminded of, remember when we had the Liberation Day sell-off. At the beginning, they tried to own it. I remember Besson going on TV and said, "Well, Wall Street had their turn for 15 years. Now it's the bottom." And that was what, like 3 days? Like that was your turn, right? And then immediately after that, we had the taco, because yes, I absolutely agree with you. They lack the consistency I think it has to do with who Donald Trump is. At the end of the day, he's kind of like weird transitional figure, half billionaire, half populist, but he can't really decide on a lane. And I think this will be settled at the next cycle.
I see. The next presidential cycle, you're saying, because he's not going to he's going to choose the stock market.
We'll figure out that the whole foreigners are going to pay for it was a great lie. Yeah. And then we're going to be forced to address it. And you could already see it with, the kind of a JD Vance or the more populist wing of the Republican. And on the other side, of course, the AOC Mandami. And I think it'll be for the better. Like that's a clear debate. Like you need to get rid of the delusions.
going into Liberation Day, I kept saying he's going to be higher in terms of doing the tariffs than people expect. Because if you remember back then, everyone kept saying, no, this is just posturing. He's not going to actually do it and stuff.
I remember you nailed this. Like you
for 3 days. And so but the interesting part about it was I was going through here and I said, okay, one of the issues is he wants to reduce the trade deficit. And I said, go look at the trade deficit, change in trade deficit versus the change in the NASDAQ. And people don't appreciate how much those two are mirror images of one another. And one of the smartest kind of pod shop guys that I know, he took me aside and he goes, listen, I'm not going to disagree with the logic of your argument in terms of how the trade deficits work and all that stuff. But I am going to push back and say that Trump isn't going to do it. He's not prepared to zero the trade deficit if that causes the stock market to get halved. And to his credit, he was right. I overestimated his Trump's willingness to stick with the tariffs if it costs the stock market going down. And so, yeah, I just, in terms of thoughts, like, do you agree that you can't have the trade deficit go down and the stock stay bid?
Yeah, because it's, the mirrors, right? The trade deficit, the capital account surplus, and where does the capital account surplus goes in Max 7. So, there's another public accounting angle that works the same ways. Because ultimately we're just playing with sector balance here. We're talking about, foreign sector, trade deficit, capital sector, and then I would add the public sector, right? If you look at public accounting, it's the savings, deficits have to be funded, right? So if you run deficits somewhere, you need to have a surplus somewhere.
Yep.
So we run two big deficits, right? We have a deficit with the foreign sector,
right?
And then we have a public sector deficit. And then our private savings are not increasing. If anything, they are the household savings rate is kind of low and coming down. And then we have this big capex boom. That means the corporate sector is saving. So if you want to reduce the trade deficit and you think that the private savings are not going to increase, you would need the public deficit to come down. At the end of the day, they mirror of each other, right? The public deficit is the mirror of the current account deficit, holding private savings constant. So again, same story about Trump and tacoing all the time. There was that attempt, there was that attempt. That was Doge. And again, that lasted 2 months, that achieved nothing. And then we got back to, $1 trillion deficit. So, yeah.
And like, if you actually wanted to fix the trade deficit, one way would be to tax capital that's coming into the U.S. Tax foreigners that want to invest in the stock market. And the trouble about
Stephen Miron mentioned that in his paper, right? There was this idea that on in order to buy U.S. Treasury, if you're a foreigner, there would be a withholding tax. You do that, or you tax consumption. You put sales tax, and that's another way to do it.
But if you think about that, then if you tax like capital coming into the U.S., that means that the price of the assets are going to go down, which nobody wants. Which goes back to the reason I bring all this up is because your original argument was we can't have asset prices keep going up, and inequality, is in essence the mirror of asset prices going up.
Yes.
So my question to you is, how does this resolve? Like, what happens, and how has it changed how you've thought about what's going to occur in the next few years?
So the way I think about it is we're a dog chasing its own tail. So let me kind of walk through how that works. So, if I start, I think the original sin really was 2008, where this was at the time, this truly was a debt crisis. This truly was something that would have seen comparable in other times of history, but we chose very different policies to get out. And if you think about like the Great Depression, right, we had Keynesian policies, massive increase in tax rates, and massive increase in the deficit. After '09, very different. The deficit actually shrank, and really relied on the wealth effect, on monetary policy to save it. The idea was, which is a crazy idea if you think about it, it's like we're just going to keep giving money to rich people until the economy, and eventually it will trickle down, and then everybody will benefit, which is, I think, one of the reasons why the post-08 recovery was so long, because it's a really crappy way to go at it. Monetary policy is inefficient, and the wealth effect is a horrible way to stimulate an economy, because rich people have a very low marginal potency consume. Now, we did so much of it, and eventually it worked, right? I mean, QE1, QE2, QE3, zero forever. Like we really committed, and it worked, but at the expense of these massive asset bubbles, which did two things. One, inflated tax receipts, and that's kind of one of my really one thing I keep focusing on is these tax receipts. So which are still very strong today, by the way. We have like 10% growth in tax receipts in the US right now, which is extraordinary. So on the one hand, you have a little bit of a fiscal room here, and then on the other hand, you have a very pissed off population because we can't afford anything, and you have kind of credit issues that are developing your tricolor first brand. So what do? Well, of course, you have the money, you have the anger, you stimulate, you cut rates, and you help the bottom part of the K. I think we'll do some of that. Maybe we can get to that later, but on next year, we'll send checks to people. Like at some point, we need a release valve. So it was the COVID checks, or the Biden, kind of pro-worker policies, because he could see that the bubble was hurting. The problem is, the moment you do that, nominal growth picks up, inflation and real rate. So oh, great, it's working. But what works even better is the moment nominal growth picks up, profits pick up even faster. Keep in mind, leverage, right? Profits are profits are leveraged bet on growth. And then asset prices, because you discount the cash flows that you discount, are much higher. And because you're repressing rates, your dividend discount model explodes. So you're trying to help the bottom guy, and you give them some income. They get the checks. For like 2 seconds they feel better, but then the top feels way better because of the built-in leverage in margins, and then the discounting models that makes asset price soar. So you go back straight where you were at the top, where you had the affordability crisis, and then that's it. So that's why I'm talking about like a dog that's trying to chase its tail. The moment we want to help the bottom part of the K, we help the top part of the K even more. And if I'm right, that the problem is that the top part of the K is kind of like making life impossible for everybody else, you go back to it, and you ask me how does that solve? I think for now that the dog just keeps, I don't know if you've ever seen a dog chase its own tail, but he runs faster until it falls. So I think we're still in that period where the dog is like, oh my God, I'm almost going to get it. If only I could reach my I'm going to get my tail this time. And I think that's what 2026 is going to be all about.
Do you think that ends when we finally do get the bond market, like saying no mas, and like that's it? Like you're laughing. You're like, Kevin, I'm refusing to kick this ball. I see Lucy line this thing up. I know she's gonna pull it away on me. But isn't that the natural like limiter to your argument? Isn't that what's gonna stop this? Isn't that what's gonna interrupt the dog from chasing its tail?
I think if we were in if we were in Brazil or Argentina, yes. But kind of given up on it, man. I mean, how long are we going to call for these bond market vigilantes? So are we screaming in the desert? Where are they? Tell me. So I guess we see them a little bit today, like 30 years at like 4.8.
Yeah.
But I'm starting to think that it. There are things that slow it down. I mean, is the fact that everybody is doing it at the same time.
Well, that's true. Much different environment than a few years ago.
Yeah. So that means that, the thing that I think you and I were kind of secretly hoping for in April, we were hoping that the foreigners would kind of punch Trump in the face. Right? That was your you're an angry Canadian there, like a hockey player looking for a fight, and we haven't really done that, right? So if anything, it's Trump has punched both Euros and Canadians even more in the face, and we kind of rolled
but
over into the
but
punches.
don't you think from that perspective? Because I have a theory about that. Because I think that the selling started. Like I think that Europeans, Canadians, all you have to do is look at our pensions. We are taking money out of the U.S. Like the big long-term money is coming out of the U.S. I think that this past 6 months has been all just people chasing the AI bubble.
Yeah.
And that has been
it's been kind of I mean, it's easy to do counterfactual history and prove that we would have been right in the
No, I'm not trying to say that because you're absolutely right. Like
yes,
it doesn't matter, as the guys on my desk say, everyone's got a coulda, woulda, shoulda account. It doesn't matter, right? Like where the market went is all that matters. But what I guess I say to that though is what happens when the AI bubble, cools or /pops? I haven't given up on the bond vigilantes. I haven't given up on this willingness to expect this to change. And maybe I'm wrong. Maybe I just, I'm just a little bit dumber and not as enlightened as you, and I'm a little more stubborn. But I don't know. Like I think your argument makes a lot of sense. Don't get me wrong, and I completely agree. And I worry that too often we are just inflating the bubble more and more and more. Right. And that, but I think eventually there will hit a point where the fiscal spending won't be allowed. And let's actually go there because that was one of my theories. But now I hear you talk and you're being recently kind of highlighting that we have more fiscal room than we think. And I must say, given the fact that everyone's hyperbolic and worried about fiscal spending, it actually leads me to believe that you're probably going to be right because you're like, hey, it's not that big a deal and we got a lot of room. So tell us what your new theory is on that.
Okay. Well, first there is this just observation I'll make again. The deficit is 5.8% of GDP. Tax receipts are growing by 10%. So, at this point, the deficit is coming down. Even the primary deficit is coming down. So if we cut rates, we are in a better position. Second, let's look at next year. So right now, the primary deficit is lower by 200 billion. And again, it's very short term. Okay, I'm not long term. I agree with you that this is the kind of lean out and nothing stops this train kind of argument. But let's start with next year. So 200 billion reduction in primary deficit achieved by Trump. Now we can discuss, I think a lot of it is really just the tax receipts being really strong, but maybe there was some Doge or whatever, some, cutting foreign aid and not doing any much spending. Second thing that's going to happen is capital gains are going to be extraordinary. So the record year for capital gain, I think, is 2022 because we're paying on the bubble and we had about 360 billion in capital gain. So by my calculation, we're going to add about $150 billion in cap gains.
Wow.
This year compared to the next one.
Can I ask, have you looked at that as a percentage of GDP and looked at what it is like versus 2000? Because 2000 must have been huge as well, right?
The Tax Foundation has very good data on that as a share of GDP.
Tax Foundation, eh? That's what I love about you. I always find some website and some group that takes care of all these things, and I'm always bookmarking Tax Foundation.
So in 2000 we had 127 billion in cap gains. Now,
an economy that was way smaller.
We're gonna be in almost 400 next year, is my guess. Maybe 350. Did nominal GDP double? Probably did, right? 25 years, growing at 6. So it's about the same. It would be about the same.
Right.
But
the difference is, by the way, that's pretty interesting, is that in 2000 we ran a surplus from those cap gains. Now we're at 5.8. Okay. Anyways, I interrupted you. I apologize. Keep going.
No, cool. So 200 billion from the primary deficit getting better this year. 150 from cap gain, and then I would throw in the not QE type of argument, right? I mean, And at the end of the day, yeah, the Fed is buying treasuries. Okay, you can call it reserve management. I don't even know what the latest acronym is, but it's like 40 billion a month that we had to take from the private sector that's going to come from the Fed's balance sheet. So that annualized to 500 billion. So I add all three, there's $800 billion in fiscal room from the perspective of Trump, because Trump's, and I'm not even counting the fact that the economy has expanded by 6-7% nominal.
Right.
And I'm big, my model of a Trump is that, he's a realtor, right? And how do you make money? How do you get the contract? It's because you squeeze everything. That's how you make the numbers work. Right? It's the guy that gets the most leverage, that negotiates the best deal. So I think that's going to be his mindset. It's not going to be some BS CBO 20-year projection. No, he's going to look at it. It's like, guys, I got a little room here, and he's not wrong. He's got room. Right. And let's say he's got like $800 billion. I mean, that's so what's going to happen? First thing is we're going to have massive tax refunds in Q1. So the OBBB is retroactive. So no tax on tips, Social Security, overtime, it's going to apply to 2025 income. Now, our brackets have not been adjusted for that. So all Americans are overpaying taxes right now. Right. So all your retirees, right, they're paying taxes on Social Security right now. It's being withheld from the checks. So when they do file the tax for on April next year, they're going to get that back. Same thing for overtime. So my estimate is that it's going to be about $100 billion in refunds, extra refund. And usually we get something like 200 billion in tax refund a year. So we're going to get an extra 100 billion there. But still, like I said, by my math, we have about 700 billion we can play with next year, and it's an election year, so it's a good reason to play. So there is room for the tariff checks. I'm a believer. We'll get the checks. We'll get them.
Don't they have to get that through Congress though?
Maybe I'm not but I mean, for now they have the majority.
Although I guess you're right.
If Trump decides, Trump will get away. I mean, which congressman is going to run on? It's literally like I'm Scrooge, right?
Yeah, that's true.
I don't want you to get. I don't want you to get.
I hate Trump so much. I'm not going to let you have this $2,000 check. You're absolutely right. That's a double comp. Yeah, I shouldn't have asked that. So given that, does that mean that you're bullish the economy, bullish stocks like going into next year?
Yeah, very much so. I mean, and again, I see the biggest risk as too hot, not too cold. I already think we're hot now. I mean, I kind of, I go back to this tax collection. Some of that is inflated by the everything bubble, but not all of it. Like if you look at withheld income and employment taxes, it's still growing at, since Labor Day, growing by 4%. If you take into account the fact that where the government shutdowns, government employees get paid, we have the immigration crackdown, it's remarkable. So it's not just the everything bubble. So my view is, and again, I think, too hard to call, just look at inflation. If really we were, we had a negative output gap, inflation will be falling off the cliff. It's not. So the fact that we have inflation tells me that we are kind of pushing the economy above potential GDP. So we are already hot, and I think we will be. So most people haven't really factored in their analysis. The 100 billion in tax reform is certain. Now there's about 100 million fiscal households in the U.S. So it's $1,000 ahead. Like, remember the last time we sent $1,000 check to people?
Yeah.
What happened? Everything took off, right? I mean, who knows where it's going to go? Is it going to go to like stupid meme stocks? Probably some of it. Is it going to go to paying insurance premium? Is it going to go to save? I don't think it's going to go to savings, but
okay, because I'm curious about this, because no one's been able to answer me this, and it sounds like you actually do have the answer. To understand the one big beautiful bill, you're saying that the reason that there's going to be money flowing out to individuals is because although the rates and all these kind of lower taxes were applied to 2024, everyone is being deducted based upon 2025. It's applied to 2025. Everyone's being applied, it's being kind of being deducted based upon old levels. And so therefore, come 2026, when we do the refunds, they're going to send back the money to actually feel it. So even though they cut taxes in 2025, it's not really felt until 2026. Is that what you're saying?
Yeah, correct. Yeah, so we basically all overpaid taxes. Anyone who paid taxes on overtime, on Social Security, on tips income is going to get that money back. And by my calculation, that's at least 100 billion.
Wow. Okay. And is there other elements of the One Big Beautiful Bill that is stimulative at the beginning of the year? Because everyone talks about how it's this stimulative policy. Is there some tax on CapEx and stuff? Is there something that on that perspective as well that encourages more spending?
So, I mean, I think that's already happening, right? That's part of the reason why we have this AI CapEx boom is that kicked in straight up. So the 100% depreciation, that was in 05. So, going back to tax collection, and I actually don't know why that happened in September. So if you look at corporate income tax collection, usually, so it's paid every quarter. And then all year long, we're kind of tracking a little bit above 2024. And, I remember thinking, that makes sense, right? Profits are up. And then I remember being horrified. That was part of my case for a full correction, which turned out to be kind of off. The October payment of corporate income tax came in way lower. We were short 50 billion, like half of it didn't come through. And then I realized, oh no, that's the capex. 100% of the capex. It can be depreciated, and we have now. Why did it happen only in Q4 versus? I would have expected, because my understanding is we should have. I don't know. Maybe it takes time, right?
I was going to say, I think if you're putting shovels in the ground, you don't just get out and immediately start digging. Yeah.
But I think it's also one of the reasons why we are seeing this, data center boom and all that is because it's free. Like basically they can write off 100% of the tax. I mean, if you're a Google or whatever, the fact that you can write off 100% right away. Maybe it's not economical. Who knows? Like it basically, you might as well do it, right? Because if I don't do it, the next guy's going to do it. So I mean, to your concerns about like inflating the AI bubble, I think that's part of the story, because we are telling companies just throw money at the problem, and hopefully something will come out of it.
By the way, Vincent, one of the things that I love about you is your doggedness in terms of watching those accounts. And it's truly something that just separates you from all the other strategists out there. I'm sure there's others that do it, but I don't know any that are as good as you and follow it as close. Like you're following
on taxes. I don't know if you follow this guy on Twitter. I love this. He's a starfish Wabuffo. His profile picture is a starfish. I know there's a sub X of 5 or 10 people that are obsessed with tax collection, and
Well, listen, you're too kind. You're deflecting because you're really great at it, and I think it's a great way of thinking about it when you're looking at the macro economy. Like you're looking at the actual cash. Like it's like the stock analyst that says, "Show me the cash flow statement," instead of worrying about the EPS.
Especially now, since we are an emerging economy who no longer produces statistics. So, I mean that's all we got.
All right. Put together what other macro kind of themes, or here's something I actually ask you. When you go talk to clients, because you do talk to a lot of clients throughout the world, what are they feeling now? What are they frustrated by? Where do you think they've got it right? Where do you think they've got it wrong? I'd love to kind of get your thoughts on what you're seeing out there in terms of the institutional community.
I mean, it's not going to be a big surprise to you, but it's really this AI thing. I mean, the last roadshow I did was in LATAM just around Thanksgiving, and that's when we started to see some of these issues with the Oracle CDS and kind of circular financing, and yeah, I mean, it's a problem. Anyone who has any allocation to equities is, it seems to me like we're all in this train, just every portfolio manager, every investor, anyone who has a 401k, and even policy wise, like sorry, I'm going on a tangent, but
no, go on the tangent. That's what we love.
Something else. Like when you're talking about this kind of contradiction for Trump and Besant, where they see the problem, they see that the tax the foreigners didn't work. I think the way they solved it is just like, yeah, AI is going to solve it. ChatGPT. Like I think we just throw.
Oh, you think that they view this as a magic elixir that's going?
Yeah, it's like the magical wand that was going to make everything better, and somehow we got this. That's kind of the Kevin Hassett argument, right?
Yeah.
Why we're going to have lower rates is because we get this kind of 1990s productivity boom, and it'll be the Deus ex machina that gives us this pain-free deleveraging,
right?
Because ultimately that's what we're trying to get, right? And Ray Dalio called it the beautiful deleveraging, right?
Right.
And that's something that Wall Streeters kind of like, because it's like it gives the idea you can have your cake and eating, or you can deleverage and it's still beautiful. No one feels the pain.
Yeah.
By the way, I need to give credit to Ray Dalio. Like if you actually read what he writes, he does mention this policy, these redistribution policies and much higher tax rates. It's part of the package. We just choose to ignore it. If you look at like actual beautiful deleveraging, like the US under FDR second half or 1950s, we're talking like 75% marginal tax rate, and things that would really make like Larry Kudlow's head blow up on live TV.
Okay, so go back to the clients. So everyone's worried about.
It's all
right, no problem. I'm still thinking about Larry Kudlow going berserk on live TV, which is par for the course. He goes berserk if Obama wears a tan suit. So this would be something that'd be really easy for him to go berserk on.
No, everyone is worried about this maximum bubble, and to your point, going back to what you said about the April Liberation Day correction, is because they stayed. Right? I mean, they stayed for the AI bubble. All the foreigners. I think what we saw was maybe hedging of the dollar. The trade was kind of long Max 7, short the dollar. I think the dollar shorts have come off mostly as the dollar kind of stabilized, and now they kind of left with this massive position, and everybody's kind of nervously watching one another. And it's like, when is the music going to stop?
And do you think that come the new year, or do you worry because you're kind of a newfound bull, that they're going to say, okay, you know what, I'm long all this Mag 7, I'm going to sell it because I just, I wanted to get through this new year, the past year, and I'm going to sell it? Or do you think that they're still in and there's no signs?
I don't think that's how psychology works. I mean, the more something is good to you, the more you cling to it. You don't, especially like, anybody who's, still has a job today, I look, for example, I talk to a lot of Chilean pension, but Chile has this interesting pension system, and they kind of, it's like a horse race. They evaluate it on performance. And so whoever stay, basically that ensures that the ones who are here are the ones who are overweight US. And the guys who listen to too much Kevin and Vincent talking about Brazilian stocks and Chinese internet 3 years ago, they're unemployed. They're begging in the street.
You mentioned the Fed. Do you have an opinion on who the next Fed chair will be, and do you think it matters?
It seems, if you look at the betting odds, it seems to be Kevin Hassett. Does it matter? I don't know. Powell sounded really dovish to me already. Like it seems like Hassett is already there. So I'm not sure how different it's going to be. I think this bullying of Trump worked. It's so it's gonna happen no matter what. We're gonna have a political Fed. the question, you have all these questions about like board composition and whether Powell stays on. But my impression is that Trump has won the war, and now the line is productivity is going to boom, tariffs are not inflationary, and the economy is so great that we need 200 basis points of our rate cuts, and everybody's falling in line.
Okay, so I've asked you a lot of questions. What question do you think that I've missed? Like, what would you have asked yourself that I've missed? Or here's another idea. What question did you get recently out with clients that you thought was like a really interesting, great question, like something that was outside the box, or a way of looking at it, or a question that might have slipped on a traditional interviewer?
Well, I actually think you asked that question. I just kind of forgot to respond to it because I got lost. How does this end? You suggested this kind of bond market vigilante story, which I must say my faith is diminishing by the day on that. Yeah. I think it's inflation and a hard turn to the left at the end of the day.
Oh, okay. So it ends politically instead of financially.
Yeah. So we are in this kind of like dog chasing its own tail, and it's going faster and faster. We will stimulate like crazy in 2026 because Trump cannot afford to lose the midterm. Really, physically, he could go to jail. And I think that's something that's I get that. My clients in Latin America get that because if you're in Peru, like the past 6 Peruvian presidents are in jail. It's true.
Is it true?
It's like Chicago mayors. It's like you go straight to jail after Bolsonaro is in jail. And I do think it changes the nature of the political game. Like if you're like Obama and you lose the election and you get to retire on Martha Vineyards and get your podcast and become like a world superstar, you're fine. But like if you have to fear physically for your life and that of your family, and who knows with the Epstein stuff, there might be some like actual criminal things in there.
Yeah.
So that changes the incentive. That means that you really go all in, and I do believe Trump will go all in. I still don't think it's going to be enough. I think it's going to look a lot like the 2022 midterms, where it was forecasted that the Democrats would get a beating, and they did better than expected in large part because there was all this stimulus. It did work. Like if you send people checks and you can buy vote. I mean that's how politics are conducted in Latam for hundreds of years now. So, but I think it still loses. Then we get this kind of like gridlock, which is not good. Nothing happens. The situation gets worse. Inflation becomes more and more entrenched. And then by 2028 is where we get the hard turn to the left, and we can already see all the signs that are here with Mondami, with the election in Miami. And that's when we get the missing policies. When going back to this kind of deleveraging idea, and the one that we conveniently drop because no one wants to hear about it. Okay, yes, we boost growth, we repress rates, and we need to have at the same time very distributive policies, higher tax rate, taxing capital gains and corporate income. So that's how I think the music ends. But it's more of a for the short term. No, I don't see the Deus ex machina, like the people suddenly. It's January 2 when their worldview has changed. If anything, if I'm right about the tax rebate, and
they double down.
Who's going to get that? It's going to go straight to Amazon, okay?
Yeah.
And the bubble just keeps inflating, maybe like a blow off top type of situation.
I think that insight about Ray Dalio and the fact that he talked about one of the ways of delevering is actually by redistributive taxes is something you're right. Nobody talks about, and unfortunately. They don't want to see it, but if that's what's going to end up and that's where we're headed, then you should prepare. But as you say, that might be, 3 years from now. Okay, so Vincent, I realized, first of all, I'm not allowed to talk about Emily in Paris. You did something, I think you won a bet once, and I said I promised I would never bring it up again. So I'm not bringing it up. But I realized, and I'm putting you on the spot, and I feel bad about this, but maybe you're, quick-witted enough that we'll be able to do this. Recently, I've been asking guests for their what we call the Desert Island Finance Edition. So Desert Island is this show on BBC where they ask celebrities for their top 10 albums that they would want to be stuck on an island with. So I do Desert Island Financial Edition. We only ask for three bands or 3 albums. Doesn't matter. You can pick either one. I'm trying to give you some extra time here so you can think about them. You get them all sorted in your mind. And then we also ask that you're allowed to pick any trader through history that you want. Okay. Any trader through history. So you could pick Jeff C. Livermore. You could pick whoever you want to be on this island for you to trade and chat with. Okay. Are you game? Do you think that I didn't give you any heads up about this, but are you game to play?
Yeah.
Okay. So first, let's start with your first 3 bands or 3 albums.
Okay. So I just went to the Oasis reunion concert in Santiago, Chile. And it was awesome. And, I tried in the 90s. So they haven't really produced anything, and but it's good. Like they understand the assignment. They do the favorites, and it was awesome. So I'm gonna pick them.
Okay.
With 3. I'd have to go with maybe Pink Floyd.
Okay.
And then I gotta give the French. The French is kind of harder. For those who know, I'm hesitating between Renaud. It's kind of like a working class. I mean, his voice is terrible, but he's a very
he's the Bob Dylan, Neil Young,
exactly.
Neil Young of France, the Neil Young of France.
Yeah.
And his name is Renaud. I might like him. Is it like folk? Is it like folk rock?
I'll send you some stuff.
Okay.
Or if we just want to go for like sheer musical quality, I would go with Jacques Brel. Ne me quitte pas. I'm sure that you've heard the song before. If You Go Away is the American version of it.
Okay.
So these are my 3. I'm allowed dead people because I'm pretty sure some of these people are dead.
Yeah, you're allowed dead people. And now, What about your trader? What trader would you have? And you're allowed a dead trader if you want to. You can Weekend and Bernie's it.
I mean, the easiest is Sake Druck, but everybody's gonna. You know what? I'm gonna take Dalio. Just
that's a good one.
I want to talk. Yeah. I want to share some chemical product with him. Ask him about Burning Man.
The trouble about Dalio is that you have to be brutally honest. He's gonna be like, oh God, if you stink. Like he's just gonna tell you how it is.
Personal story. I mean, I actually almost worked there. It was when I was really starting my career. I did the whole interview thing with them. It was brutal and gruesome, and and I'm not equipped, man, for the brutal honesty. Like I remember I did really good on the whole, like, so they have like all these like IQ things, which like McKinsey bullshitty things, like how many golf balls in a swimming pool, like blah, blah, blah. Which really only tests whether you've read the McKinsey interview book or not. Then they had the capital markets question, which was surprisingly not so difficult. And then it was these, you know what? I think it was probably right at the end of the day, this kind of philosophical debates. And I remember getting visibly angry by, that, and your interviewer is just constantly contradicting you. And in the most annoying way, they have all these kind of like, trust fund baby there. And I mean, you and I go left, man. I'm a man of the people. Like I believe in this stuff, and I realized in the middle of it, I'm like, oh my God, I'm making a Marxist argument and then I could not handle the brutal honesty of it. So I think sometimes we need to be, not dishonest, but polite. There is something to be said about social grace.
Yeah, I hear you. And you have plenty of that, my friend. So why don't you tell people that want to learn more about yourself and your firm? First of all, tell people about StoneX, what you guys do, and then where they can find your great research.
Well, so StoneX, kind of a Fortune 100 company now, growing very rapidly. I work for the broker dealer side of it. So we do everything. Started historically, we started with commodities. We're very big in physical gold, which has helped us very well. All kind of the ags, the soft. I'm on the security side. I write weekly reports, which goes to our clients. So if you're already a client of StoneX, reach out and say I want to get Vincent stuff. If not, under my pinned tweet, there is a link where you can sign up for a free trial. We can also work with even if you're not a client of StoneX, because of MiFID, there's a way that you can subscribe to the work. It's fun. I mean, I've been here for almost 10 years now. It's been a great firm that's grown a lot, that let people do things, and kind of stepping in this, I feel like the concentration in trading has left some gaps that that the big banks or the big guys are not filling. So there might be a fit here.
Awesome. So you mentioned your Twitter, but you didn't mention what the handle was. Why don't you tell people what the Twitter handle is?
So it's at Vincent, Vincent Deluard, Deluard. At Vincent Deluard.
Thank you very much for being with us. It is always such a pleasure. Thank you so much for your time.
Thank you very much.
All right, Patrick. Last one for the year. So make it a good one, buddy.
Bud, things are spicy out there. Now, first of all, the last 2 weeks were incredibly boring.
Yes.
It's like watching paint dry. Everyone wanted to hear what the Fed was doing. At least that was sort of the inflection point, was waiting for that. And in the end, what was interesting is while the equity markets were super flat, the rates markets were moving, and even the dollar started moving a little bit. Well, I mean, they were pulling it out. It was everyone was pricing in, correct me if I say anything incorrect, but everyone was basically pricing in a hawkish cut.
100%.
Right.
And you know what? I wrote about that in my chat that I have every day. And I got up before the Fed and I said, listen, I'm looking for a hawkish cut, but one of the smartest guys I know told me that everyone's looking for a hawkish cut, and that the reality is that given that expectation, chances are it's going to go the other way. And he was spot on correct. And I said, this guy's pedigree is a lot better than mine, so you should listen to him and not me. And sure enough, that is exactly what happened. There's too many people. Hawkish cut was priced in. That's in essence if you had to sum it up, that's what you sum it up. And it just wasn't going to be hawkish enough. And not only that, Patrick, if you remember back to that November meeting, that FOMC meeting, it was really hawkish. So people had a little PTSD, a little scare, a little bit of, they remembered how much Powell came and stomped on it. So they were a little nervous. And that's in essence why there was too much bearishness going into the meeting.
Exactly. So let's talk about the aftermath of the meeting, and more importantly, what's been happening today, because this is much more of like that Oracle AI kind of driven thing. At least that's the headlines I'm seeing. You can tell me if there's some other underpinning drivers of it, but some really interesting dynamics. First of all, actually, let's first talk about the Fed. And then we'll talk about the markets and what this thing, what's going on. So first of all, pretty much the market is, at least at this moment, pricing in a Fed pause for January.
Yes.
So we got a 75% probability that they don't move. And at the same time, now basically out to April, the probability more or less of them still having not moved versus having one rate cut is about 50-50.
Right.
And so more or less, there's a 50-50 chance that was Powell's last cut before a new Fed chair steps in. And at least that's what the market is pricing right now. But what I'm kind of surprised at, Kev, well, I guess not surprised, but like I feel that there's a lot of things that can happen in the data that still could forced the Fed to be more dovish in this window, and I think this may very well still be too conservative in terms of that they're done this way. But I do think it will be data dependent. I'm not in any way trying to imply otherwise, but these jobs numbers are coming out next week. First of all, what's your kind of gauge on what to expect from the jobs numbers on Tuesday?
I think it's really difficult. There's too much going on. There's a lot
difficult.
of there's a lot of
saying.
there's a lot of different parts.
But
and like not only that, I think if I gave you the jobs numbers and they were only slightly, you wouldn't know what to do with them.
It has to be an outlier to really kick the feet out from underneath the market. It has to be a big surprise. But if they're weak in a bigger way, then suddenly January is going to have to be baked into a cut. Like they're going to start. I think they're going to lean to a much greater probability of a cut than not.
Well, but Patrick, I completely agree with you there. The real question will be like not what the front end stir traders do, because that will be fairly obvious. What do the equity traders do with that information? Do they like cuts, or does the economic weakness scare them?
The precedent has been that they will like the cut. At least that's what the behavior we have seen in the past. Now, I feel like it's one of these scenarios where if they're cutting because we're going into a recession,
that's much different.
It's much different.
Yeah.
But here, if the recession risks are not as high and they're cutting, that means that they're easing, providing that liquidity, which allows them to be baking in higher stock prices. So I think that the response mechanism of that actually surprisingly may initially be positive.
Yeah, listen, I'm with you. I think though, in a really, really bad employment number, like if there was a real uptick I think that
clarity that there's a recession coming.
Yeah, I think that if it was viewed as more than just a slowdown, I think that they would sell stocks. But I hear you on your point that the initial reaction, if it's just a slight slowdown, might be that this is kind of the soft landing everyone's looking for. It gives the Fed more chance to lower rates. And I think that one of that'll be really interesting, Patrick, if that does happen, do smalls just rip on that? Because smalls are very tied to rates right now. And that is what's moving those. And they broke out to new highs. And so
let's talk about all this. Okay. So let's talk about the interesting sector rotation thing that really almost seems to have developed here. Now the interesting part, was it the reaction to the Fed or was it Oracle? Is the bigger question, because Oracle missed, and it seems to kind of send some ripples through the NASDAQ and many of these AI names. And so, first of all, do you believe that this little rotation we're seeing is much more driven by these AI headlines or the Fed?
I think it's both. So first of all, I do think that if you look back, often the Fed marks a turning point in the trend, and a lot of times we've seen this before, where we've ripped on the day of the Fed, and then that's proved to be the high. So that's not unheard of. Now, having said that, there are a lot of bad headlines in the AI, and I you know me, I'm a huge AI bear, not in terms of like the technology.
It's going to be the bubbles got to have the air
like it's
taken
ridiculous.
out of it.
But Patrick, I think the Oracle is one thing, but there's this Fermi or something. I don't know. FRMI. Dial this thing.
MI?
FRMI. Okay, so this thing came public at $21. It's a REIT that does for data centers. Came public at $21, traded up to 35.
Now it's at 10.
Chugging around at 15 for the past, couple of weeks. Just announced that I don't know, I guess their main only customer is said no mas, like I'm not in, and the thing's $8. Or what is it right now? It was $8 when I looked at.
Well, it's $10, but it was down. It was down in the 8 handle for sure.
So listen, this was something that investors were just couldn't get enough of, a couple months ago, and it shows you how the sentiment is turned in the AI square. And although everyone keeps talking about this and they're talking about it like it's always going up and things like that, these things are going sideways. Like, you're going to show us some charts, and I'll bet you that the vast majority of these AI stocks are going sideways, and maybe some of them are even going down.
Yeah.
At the very least, they're not leaders anymore. And then Patrick, did you see the Time magazine cover?
No, what was it?
It's okay. So there's this famous steel worker thing back in the 20s. And I think it was 1929. This picture was taken. It was in a skyscraper in Manhattan. And it was a bunch of workers sitting there eating their lunch way up high. So they took that and then they put in the 8 gurus of AI, like Elon Musk, Sam Altman, the Microsoft guy, all these different guys that put them on there. And it's like the AI architects is the Time person of the year. And just ring that bell, baby. Just ring
that bell. Ring
like
bell.
Brent Donnelly, by the way, has got this great kind of study, or I don't know what you want to call it, but he tracks this, and he comes up with these things when he sees a magazine cover. He comes up with a trade and then he tracks it, and these things work way more than they should. For anyone who's interested, go look up Brent's work, and he keeps this up, real time. And to me, it's just one of those things that we're going to look back and say, holy smokes, when they put him on the cover of Time, that was the top.
Yeah.
So I think we're there. And you tell us, you go through the charts and tell us if that's the right call or not.
First of all, the puzzle that I was trying to solve, and I think we talked about it a little bit last week as well, last episode as well. But to me, we had this 6% correction. So all of this talk I had from August, September is like, we're due for a correction. It's overdue, longest period without a correction. But once we printed 6% down, the correction was done. Well, I thought it could have been deeper. I thought it could have gone further. It could have been a 10+% correction based on the magnitude of the rally, but it was what it was. So the correction's over. So the immediate downside risk of the market is on the very short term not there. So the question the puzzle that I was trying to solve is this the midpoint of a bull continuation pattern where we go to 7,400 on the S&P, or is this a part of something like we saw at the start of the year, which was like a 3-4 month topping formation where the market struggles along overhead resistance and fails to follow through bullishly on the upside. Now, the interesting part was I was looking at a couple of things that I thought was really important. Number one, I was watching whether the financials could break out of their 4 or 5 month trade range bullishly on the upside. And here we have the financials bullishly breaking out. Yep. At the same time, I was looking at the SMH, the semiconductors. And literally on Wednesday, they actually printed a fresh new 52-week high, even though obviously this news has caused a little bit of selling. There was a lot of these things that were actually showing that the market was improving, including we managed to muster up a little bit of a higher high on market breadth, getting up to 60% on the number of stocks above their 50-day moving average. So there's actually some money flowing, but it is becoming very clear that it is a sector rotation rather than the tide rising where all ships are rising. And this is the interesting part, because like you were suggesting with the small caps, I'm going to start with the S&P equal weight index. The S&P equal weight index did not waste any time breaking out to fresh 52-week highs, even though the main S&P has not been able to. Similarly, the Russell has been able to break out to a fresh new 52-week high. So what we're seeing is the money very clearly rotating. Things like money, energy stocks are being bid. Healthcare stocks continue to hold up very well. The small caps are doing well. All of actually the entire commodity complex in general, outside of in terms of commodity stocks, not commodities themselves, because nat gas and oil itself have been struggling a little bit. But when you're talking about equities in the commodity space, they've all been just on fire. And so there's money that's going into all of these little places. But we are seeing the stalling out of things like the NASDAQ. Like the NASDAQ didn't go anywhere near its previous high, and the Mag 7s failed in the same way to make it back to their highs, back to testing their 50-day moving average. And what was really the most obvious thing to me was NVIDIA. NVIDIA could not close above its 50-day moving average. Like, so here we have the NASDAQ at least attempted to double top, retest its highs. You had the S&P actually pretty much retest its highs. So you have these markets that made this big counter rally, and NVIDIA couldn't even muster up a close above its 50-day. And even like another one of the very popular ones is AMD. Look at the lack of follow through bullishly on the upside on AMD, even though the semiconductor index has made a fresh 52-week high.
Yep.
These two big boys have couldn't even get a bump on there. And so we're clearly seeing that managers that were grossly overweight these Mag 7s and AI stocks are starting to diversify. They're probably resizing all of their AI exposures and redistributing it amongst the rest of the market, which is what we're sort of seeing in this dynamic of what's working and what's not working on the short term. And so there's something going on under the surface here. The question is it outright bearish? Yes, it's definitely short-term bearish for AI stocks. But is there going to be a bigger problem to the whole stock market from that? Or could we have a divergent market where this initially starts off as some profit taking and selling in AI, while the rest of the stock market is actually a benefactor of that rotation, because not everyone is just liquidating in a correlation of one kind of scenario in the market where everything starts going down. What's your take on what I said, and what would you interpret differently?
Oh, I think you're bang on. I think it's actually the question to ask for 2026. Will we be able to have a correction in the Mag 7? Because so far, the Mag 7 just have been sagging a little. They haven't really, truly gone for sale yet. When the correction comes and we go down a quarter, a third, maybe even a half in those stocks, will the other names be able to go up enough to stop the indexes from getting absolutely destroyed? And I know a lot of people seem to think that that's not the case. So once Mag 7 rolls over, the whole market will go with it. I'm not as confident. I think that the rotation might be way more violent than anyone expects. I think all you have to do is think back to the gold miner stocks.
Yeah.
And it was only 9 months ago that it felt like you couldn't give those things away. And now they're up 100% or whatever, and they're just on fire. And it just goes to show you that when the money comes for this sector, it's going to be massive, and the moves will be massive. And to 1 second, the point is though that the amount of money in the top 10 names in that Mag 7 plus a few others and stuff like that, it's so large. Like 40% of the S&P 500 is comprised of those top 10 stocks. That is unheard of. It's very, very large. If we got some movement within it, then the amount of money, actual dollars that are going to come out of those names and go into those other names that they're going to have to buy is going to just move those things by a huge amount. And I think that's why we're seeing with the small caps.
Yeah.
Small caps are tiny. I bet you, I don't know the numbers, but it wouldn't surprise me at all. I should probably do this. Like if NVIDIA is smaller than the entire small cap market, it's probably something stupid like that.
It probably is something stupid like that.
Yeah.
So the question, okay, so the easiest thing to maybe play as a relative trade is you say, well, look, I think the equal weight S&P will outperform versus the main S&P, right? Because the market capped S&P is just going to get dragged like an anchor on these. But I actually think next year will actually have to be a stock picker's market. And I think that you shouldn't just assume that a bear market in AI or a pullback in AI will necessarily equate to the fact that you should be sitting in cash or treasury bonds. That in fact, there might be things that are working. The most obvious example to me was back in 2008. While banks were the focal point of the selling in the first half of the year of 2008, energy stocks were up 70% higher in the first half of 2008. Right, there was a place to make money in that circumstance. And while I don't necessarily think that it has to be that same dynamic, but the point being that there will probably be areas that are going to do well, irrespective if there is selling, but you probably aren't going to get the benefit of by tracking the index. You're going to have to be a stock picker. You're going to have to actually see which sectors are taking the flows, which sectors are the ones that are behaving resiliently, and you're going to need to be much more concentrated in the things that are working and in trend, and be massively underweight those things that are being dragged in a downtrend.
Patrick, I saw this interesting stat the other day about a percentage of active managers who beat the S&P 500. And it's shockingly low. And not the real problem is it's not just shockingly low this year. It's shockingly low for the past 3 years. This has been an absolutely impossible market to try to, beat the index. And the reality is the reason that it's been so difficult is because that index is so top heavy with those Mag 7s. Like even to just be full index weight on those is a real leap of faith. So it's been really, really tough on active managers. And I 100% agree with you that in 2026, we could see a situation where the vast majority of them outperform. And you say, well, how can that be? How can the vast majority of them outperform? Well, that might occur if we see a situation where those Mag 7s go down, and inherently they'll be underweight that thing. And this is going to be a stock picker's dream. And I'm with you. I think that these things could go up. Not only could they just not go down as much as the Mag 7, I think we could have things ripping and going higher like we've never seen. I think the market is underappreciating how much violence there can be within it.
And if that's, but imagine what, for instance, as an example, we could see an incredibly big continuation of the commodity bull market next year. And let's segue into the dollar here for a moment, but if this dollar advance has played out, right? Like I was always cautiously bullish the US dollar in the last 2 months because it's been above its moving average, making higher highs. There was room for it to retrace back to 102, 103. But clearly, that momentum has massively stalled. And while I would not yet officially call this a re-resumption of the prior downtrend, if the unfolding reality going into January was that the US dollar is resuming its prior downtrend, when we go on a weekly chart and look at where the 2021 low of the US dollar index is, it's down at the 90 level. If this flagging formation breaks with a downside move, we're talking about a measured move that could easily slam it back down to retesting 2021 lows. Now, I'm not forecasting that yet, but what I'm trying to get to is if that became the reality, that would be a huge bullish tailwind to the reflation trade, and many of these commodity names would actually be huge benefactors of that. And so we could really have a dynamic where international equity, emerging markets, commodity markets, all of these things could actually be taking huge inflows and being doing well. But when you're an international investor, overweight Mag 7s, and the US dollar is going down, and at the same time as your Mag 7s are going down, you could actually have a negative feedback loop as these international investors start actually reweighting themselves and bailing out on this trade.
You're spot on correct. And by the way, that folk hero, the currency whisperer, he emailed me. And the thing about the currency whisperer is you can't ask him for it. You got to wait for him to come to me and say, I'm putting this on. And
well, that's
I got
a true whisperer.
He is a true whisperer. And I got the message from him. He said, I'm, he says, wish me happy holidays, Merry Christmas, the whole 9 yards. And then he said, by the way, I think it's time for the yen to go. And I know he's been a yen fan, but this was a new one. He's buying Australian dollars.
The Aussie, eh?
Yeah.
Well, you know what? Okay, so let's look at this weekly chart. Well, you know what? Well, listen. If the commodity story combined with a weak US dollar plays out, then you have to think that the commodity-based currencies would have an extra kick on them.
Yes.
Now, what's interesting is based on that employment number in Canada as well, the Canadian dollar had a very distinct little uptick. So first of all, you can just pull out that super thick crayon and draw that trend line along these highs for the Aussie dollar. I mean, this thing is toying with, on a weekly chart basis, breaking what has been a 4-year downtrend. And potentially making a higher high for the first time. But let's take a look. I'm going to do the unforex thing and look at the Canadian versus the US upside down chart.
But wait, before you do that, going back to the Australian dollar, let's not get rid of the Australian dollar yet. Would this be an asymmetric trade?
Ooh. Wow. And I'm glad you asked, Kevin. But in the end, all of these are potential asymmetric trades. Every one of these, obviously, the first thing that we do, Kev, is we always try to use our macro frameworks to build an idea of what can happen and why would it happen, right? Like we try to understand, and then we technically are always observing, when has something actually potentially started and where could it go, right? So we're trying to combine this world. And then it's just simply about using our, whether it's using disciplined money management skills with stops and risk management, or whether you construct a proper options trade, you're always trying to construct every one of these themes in some form of an asymmetric thing. Thanks for the plug.
Oh, definitely. By the way, Daniel's gonna be mad at you if you don't actually name when the conference when the webinar is. So repeat it again.
Absolutely. Oh, there you go. Well, thanks for the shameless plug in the middle of the chart.
Well, I blame Danny.
It is on December 16th. December 16th on Tuesday.
Yeah.
And it's going to be at 4 p.m. Eastern time at the end of the day as the market closes. And so please join us. You can find the link in the description of the show on YouTube, or you can go to bigpicturetrading.com. Thanks, Kevin.
Okay.
All right. No, so can I go to the Canadian chart now?
Yes, you can.
All right. And what's interesting is on a weekly chart, the Canadian chart actually looks almost identical to the Aussie in a sense that it's been in a downtrend since 2021. It's been in a pretty vicious decline. You can kind of mash up all of these highs, whichever depends how thick your crayon line wants to be to connect highs. But in the end, what you have is the Canadian dollar did a very clean 50% retrace back over here, establishing a low. And the question here is the Canadian dollar going to shock everyone with a leg higher? Like, I'm not yet super convinced that this is 100% happening, but you can't ignore it, because this could be the kind of early moments where we're seeing a new trend develop. And it obviously, if you get in early, you can always get the better fills, but then you always have to have an exit strategy if it just doesn't materialize. But we're definitely seeing price action that's reversing. Now, well, the one I want to talk about here is that US dollar yen. And the one thing that you were mentioning here, like, it's got very clear overhead resistance. And this is where the Bank of Japan has intervened in the past. So, I mean, there's a good chance that at least your risk is limited at this stage if you're dabbling with a long yen trade. It's very early. At least the Aussie and Canadian dollar are actually reversed. You can see that they're attempting to break out. I'm going to reverse this. But the yen is actually still trading at its low.
Right.
Like this is an incredibly premature call, but it is at a support line. And if the support actually holds, then that's a rock star entry.
Well, he's a little bit of a rock star, so I fully expect.
I mean, he whispers to currencies. I mean, that's a true rock star position, right? So anyway, on the currency front, I think this dollar call is going to be one of the big 2000. I think, Kev, for our January show, we should kind of theme it as to a 2026 outlook. Talking charts where we don't even look at daily charts, we'll look at weekly charts and really kind of try to really size up what could happen. What are the kind of asymmetric ways that the 2026 can play out, and where are some different trade ideas? I think that would be a great 2026 primer for everyone coming into the new year.
So you get it ready. We'll be ready for you.
In a month, we'll do that. All right. So listen, we gotta talk. So anyway, back to the equities. Will that rotation happen? Big thing, like the fact that financials broke out, it means to me that this isn't a broad S&P 500 sell-off. This is very much the AI having air taken out of it. It's not where the vast majority of stocks are down, and there are places that are doing well and taking flows. So it is not overly alarming. The other thing is we do have low volumes going into the holiday period. So obviously the jobs number can create some volatility next week. But if we don't see a big move and the jobs number just comes down the center, and then we have gamma pinning kicking into the OPEX, then low volume, half cut weeks. We may be just stuck in a trade range for the rest of the year.
Yeah, I don't disagree. For those who are interested, the JP Morgan upper strike on the call that they sold is 7,000. Like, although I'm probably too bearish to really think we're going to pin to there. A little part of me says don't overthink it. That's probably where we end up, like December 30th, not December 31st, because oftentimes the December 30th, 7,000 would be a natural spot to pin it to.
Like, I'll tell you, like on this chart, if I would say, like, let's say we dip here 1 or 2 more days, the jobs numbers isn't as bad, or maybe it is bad, and the market takes the rate cut odds up, and the market has a punch to 7,000. The reason I think 7,000 is super interesting, Kev, is because the market has a history of gravitating to key round numbers like that.
Yeah.
And for us to be this close to 7,000 and not printing it at some point doesn't it's not natural.
It's not natural.
No, history shows.
By the way, do you know what day was the top in 2021?
No.
It was like the last day, I'm pretty sure.
Really?
Let's pull it up. I'm pretty sure it is really close. If it wasn't that day, it was the December 31st, 2021. So remember, we were all excited. It was, this was the big rally off of the 2020 lows. Margaret was doing great. And then she ran right into the year end.
This was January 4th was the highest.
Okay. So it ticked up a day or two. But
28th and 29th was that little surge right at the very end. And that was the high, and it just sold for those.
And it held for a couple of years.
Well, yeah. Well, I mean, that was the bond massacre.
Yeah.
Right?
And I know everyone says, oh, well, this time the Fed's cutting, so that won't happen. Like, sure. Okay. Yeah. There's always a reason. There's always a different reason. So I just thought that was interesting. And I contend that part of the reason that there's that sort of seasonality to it is because of the preponderance of derivatives. And, Jim Carson talks about this all the time, these autocallables and all these bonds. I mean, all these notes that they're issuing that affect the volatility. Like, I'm bearish, so I probably want us to sell off going to year end. And I feel like often, like everyone's looking for the year end rally. So kind of worries me that I'm in that camp. But a little part of me just says that would be the most logical thing, would be a close at 7,000. that would be what would make a lot of sense. And if you were to say like, don't overthink,
but I don't think it's a
stupid.
big accomplishment. 100 S&P points above.
No, I
the
get it,
previous
but
high.
I think though, to say that that's where we end up on the last day, like that's kind
It's
of
not a big stretch.
Yeah, but I also think that option action ends up being more important than often people appreciate. And maybe
Absolutely.
that's like that. It would make a lot of sense for them to be.
I also think that if it's also a great bear trap, like if you have a scenario where CNBC can print all the headlines, 7,000 S&P hit, and all this kind of stuff, get all the bulls frothed up before the rug is pulled out. It also kind of fits that pain trade narrative of the market makes a fool of all of us in some way or another at some point. Let's talk precious metals.
Okay.
Gold did a direct double top retest and it's been fading. And what's interesting is as gold retested that high, silver put in its first reversal day after what's been an epic month. Like what a run on silver. Just an extraordinary bull impulse to the upside. Now, I'm not trying to call a top on silver per se, but all markets mean reverts their rallies and pause and do flags and consolidations. Some sort of consolidation seems likely here on silver. It finished its measured move on the upside. And as that finishes, that's usually where things pause. So the question here is, with gold double topping and silver putting a reversal candle, is it just a break for a few weeks? Like, is this going to be where things just calm down for the next little bit? Overall, I'm quite bullish for if that US dollar really genuinely starts a breakdown, like, and the reflation trade's going, like, I don't see why we can't have another first quarter rip on the upside of all of these precious metals. So I'm not trying to be bearish, but this is definitely, from a short-term swing high, a risk that we're putting in, at least the high of the week, maybe the high of the month, for a very short period of time.
All right, what else you got?
By the way, just in gold miners also, like, look at that, like a direct retest of that high and fading off of it. So it's like you're seeing that on there. What I'm surprised by is just how weak crude oil continues to be. We've seen divergent momentum where, usually when when oil has, let's say, one of these $5, $6, $7 rallies and it tests a 50-day moving average, a failure here would usually bring about a proper $5 to $10 shellacking on the downside and breaking trend. And instead, it just bled lower, staying below the 50-day, but no downside momentum. In fact, using a momentum indicator like the MOM index, it actually got positive in a sense of divergent momentum. And so there was room for oil to try to strengthen. But again, oil goes directly test the 50-day moving average and rejects. Right. And now we're working to the low. And I know this one guy I do a podcast with says no such thing as a triple bottom. The question here is that is the infamous turtle head formation going to happen?
I don't think it's gone down to the true support level, so I don't think that you can put that in the triple bottom category yet. We still have a couple of bucks. It's still
no. But okay, no. I look at it that,
and not only that,
I look at it that this was already a double bottom back over here, and so this was already the third. This would be the fourth retest.
Yeah.
Right.
Yeah.
Right.
So it has to. Yeah.
But if I was to give you a measurement of what could happen here, if you had this rule of symmetry work, then you have a risk down to $55 to $52, right? And so you could have, and so the previous low is 56. So one of these little turtle head formations where this thing has just a pop, few dollars below the previous lows, wash out those stop losses, get everyone properly bearish, and then this thing pops back maybe starts to put in inverted head and shoulders pattern or something in there. But I think one more washout in oil has to be considered a real risk here. Just a price action is so awful that like you have to respect that the prevailing downtrend is the dominant one. No matter how bullish I want to be oil, this price action is so awful.
Yeah,
it's
and don't forget, you always have to wash out your turtle heads. We gotta get going because I got another thing I gotta hop to. So what else we got?
Oh no, listen. Okay, you know what? The only thing I'm going to look at here, the Kospi. Obviously, this is tied to this AI trade to some degree or another with two big components still holding at its highs, very similar to the way that we saw the highs holding in on SMH till today. Like, and that sell-off happened actually once South Korea was already closed for the weekend. So the question here, are we seeing these semiconductors and Kospi, are they going to put in topping formations here? And are we going to see some broader selling? And, you know, I think, Kev, I think that's enough.
That's good. That's great.
I think that's enough.
I think it is enough as well. All right. Thank you for tuning in, everyone. Patrick, where can they find out more about you, your firm, and this terrific asymmetric
We're not going to say anything
webinar
but the asymmetric challenge. Listen, if you go to bigpicturetrading.com, it's right on the homepage. You can't possibly miss it, but it's going to be a great webinar we're doing on December 16th at 4 p.m. Eastern. I'm sorry for shamelessly plugging, but we just got to get it out there. But it's on December 16th. Get to that bigpicturetrading.com website. And Kev, where can they follow your stuff?
Themacrotourist.com. And listen, bear market, bull market, we're just happy to spend some time together with you on this crazy ride. Now stick around for the after show. Okay, time to rate some beers. Yes. I'm kind of upset that I don't have one of these.
You know what? As an official party dad,
yeah,
I have to say this is a great beer.
Yeah.
You know what? The one of the characteristics of an IPA is usually they're very strong in their taste, right? And that's also a lot of where that extra alcohol is in their higher percentages. This gives you the pleasure of that nice taste of an IPA, but it's so smooth.
So smooth.
It's actually incredibly smooth in
just
terms
kind of like a party dad.
I see the smile on Danny's face, which means he's not going to agree with me. But
Danny's he hates Canadian beer is the problem. He's prejudiced against us.
What do you mean? He loved the beer last week and he rated it pretty high. So
yeah,
absolutely.
Yeah.
Oh, okay.
You're the one who gave it the amateur score.
Yeah, exactly.
Oh, okay. Okay, so give us the score. So, Patrick, you were raving about it.
I'm liking it. I'm going to give it 7.9.
Okay.
Okay, what are you at, Danny?
Well, look, I'm going to be completely honest with you, Kev. For me, I hated it so much that I had to go and get something else.
Really?
So yeah, I thought it sucked. I thought it was awful. Like, yeah, you have first of all, it's 3.5%, which is
amateur, lightweight,
amateur.
That's what's perfect for me. It's perfect for Kev.
Exactly. But secondly, I just thought the flavor was more like cat piss. I just thought it was terrible. I just thought it was absolutely awful. So for me, on this
clearly,
week,
I have no taste buds. I clearly have no taste buds.
It was because you're a party dad, you know. But for me, I think I'm going to give it a solid 4.7.
That's solid. At least you didn't do an amateur score.
Yeah, I know that's the first time he hasn't done an even on the evens.
Yeah, I know. I did that on purpose. I had to think about it there. But.
Yeah.
So, Kev, I know you have to go, but listen, I just got to share what both Danny and I are entertaining the idea tomorrow of going out to Nazaré. So they
like the surf place or the big surf
place, the largest wave in the world, and they are promoting that this is the largest swell in a decade.
Really?
And so there might be a championship wave.
Oh, you guys gotta go.
Exactly.
You have to go.
And so I'm gonna, it's a bit of a drive for Danny because he's a couple hours more south in Portugal.
But you know what?
For me,
Danny's
it's
got
like
an
an hour and a half.
Danny's got a great employer that'll probably fly him to Porto.
Absolutely.
Company
Absolutely.
expenses.
Absolutely.
Well,
No,
listen,
but,
if you
like-
guys go, make sure you get some videos and share them. Like,
Yeah,
I'd
no,
love to see it. Like, that's it. Danny, you've got all your fancy gear and you're a real videographer.
Absolutely.
Make sure you get some good photos. I want to see this. This will be awesome.
Yeah,
I'll try my best.
No, it's gonna be awesome. Yeah, we'll maybe even show if there's a really good footage. We'll show it on the after hours, maybe when in January.
Sounds good. And for those who
right.
are interested, we are having a special year-end show. We're working on it diligently. It's gonna be exciting. Lots of old friends coming back on. Make sure you tune in. It'll be published sometime right after Christmas, like on our regular schedule of 2 weekends from now.
Boom.
All right.
All right. Thanks everyone, and have a happy New Year. Because I'm.
No, you're gonna be seeing. You're gonna record something. You're gonna be able to give.
Never
you
mind.
You know what? You could say
Then
Merry Christmas because Christmas will be happening between then and there. So Merry Christmas for everyone, and we will see you before the New Year.